Hey everyone, welcome to part 2 of the overview on credit cards. So at the end of part 1, we left off by looking at an example of the average daily balance method. In this video, I'm going to continue with the daily balance method example, discuss variable interest rates, walk you through an example of what happens when you only make the minimum payment, and then lastly, give an overview of credit scores. Hey everyone, this is Michael Tortorich, and welcome to part 2 of credit cards. Just a quick note in the video before we get started. These videos are designed to complement my book, Running the Numbers, a step-by-step guide to life's major financial decisions. Each video corresponds to a chapter or section in the book, and the idea is to review the chapters and use these videos as a platform to add some additional color around the examples where it just wouldn't have been practical in the book. So to check out the book or additional videos, please visit my website at michaeltortorichfinance.com. There's also a link to the website and the book in the description below. Now let's take a look at how the daily balance method is calculated. And as I mentioned before, the daily balance method calculates your interest on a daily basis instead of once at the end of the month. Now, you can do this using the compound interest formula, but the calculations get a bit tedious. If you want to see how it's done using the compound interest formula, I suggest taking a look at the book, and for the purposes of this video, I'm going to show you in Excel as it's a bit more intuitive to look at it that way. And this Excel can be found on my website, michaeltortorichfinance.com. Here you can see we're on the Credit Card Payments tab, and starting on the top left of the tab, you can see the assumptions. And you'll notice that there are yellow highlighted cells, and these denote inputs. On every tab, there's an assumption section, and by changing any of the values in the yellow highlighted input cells, the calculations will update and flow through to the rest of the formulas. So for this example, we have a billing cycle of 30 days, in other words, a 30-day month. We have 365 days in the year, and an annual percentage rate of 15%, and the interest is being compounded daily. Now note, in this file you can also switch from a daily to monthly interest rate, and the formulas will update accordingly. Moving to the right, you can see any purchases or payments, and we're using the same amounts and dates as in the previous example, so you can see here on day 1 $1,000 is charged, then on day 11 $5,000 is charged, and lastly on day 21 $1,000 is paid. So on day 1, the interest is calculated by multiplying the original amount charged of $1,000 by the interest rate of 0.041% to get the balance outstanding. Then, the interest is applied to the original amount charged of $1,000 and the 41 cents of interest from day 1 to calculate the new balance outstanding on day 2. This compounding continues for 30 days, and any new amounts charged or paid are added or subtracted from the balance outstanding. And at the end of 30 days, in other words, the end of the billing cycle, the interest will be $49.54, which is 22 cents more than the average daily balance method. So, just as an aside, on an individual level, the difference between the two methods is pretty negligible. But the reason there are two ways of calculating interest is because for a large institution, so think about a large bank here, this seemingly small tweak in the formula can have a huge impact on the bottom line. So for example, if a bank has 20 million credit card customers, each paying an extra 22 cents per month in interest, it adds up to over $52 million in profits at the end of the year. So again, on the individual level, not particularly meaningful, but that's why you have two methods. Now, to make things even more complicated, the APR for your credit card is typically variable. Now, I'm not going to do any calculations here, so don't panic, but we do need to understand what exactly this means. So let's jump back into the pricing and terms for the Chase Sapphire Preferred card and take a look at it. So in the APR section, it'll always tell you if the rate is variable or not. So here it says the APR will vary based on the prime rate. So what is a prime rate? A prime rate is a benchmark rate that banks use to lend to their most creditworthy customers, and these are usually big companies, not individuals. So this base rate, or the prime rate, is what you're going to pay, and think about it as a risk-free rate, and that varies month to month with the market. Now, in addition to the prime rate, the bank is also going to charge a risk premium, and that's going to be dependent on your specific creditworthiness. So you can find the prime rate usually in two places. If you pull the latest pricing and terms, it should have the most updated prime rate. And if we scroll down a bit here, you can see the prime rate as of May 5th, 2020 is 3.25%. But you can also find this in the US, for example, in the money rates section of the Wall Street Journal. And I'll pull it up and you can see it here. The last topic I want to discuss is the minimum payment. And you'll often hear people say, if you only make the minimum payment, you'll never pay off your credit card. And most of the time that's entirely correct. So let's take a look at a quick example and run the numbers to see what happens if you only make the minimum payment on your card. So first let's discuss how the minimum payment is calculated. Minimum payments obviously can vary by card, but typically they're going to be the larger of 1% of your balance or some minimum dollar amount. And usually this is going to be $25 to $50. So let's continue with the previous example using the average daily balance method, where interest is calculated on your average balance outstanding for the month, and see what actually happens if you only make the minimum payment. So for this example, we'll assume the minimum payment is the larger of $35 or 1% of your average daily balance. And we know from the previous example, the average daily balance was $4,000 and the interest due was $49.32. To calculate the minimum payment, you compare $35 versus 1% of $4,000, which is $40. And since $40 is the larger of the two amounts, the minimum payment is $40. And the interest for the month is $49.32, which is more than your required minimum payment. So if you only pay the minimum, not only will you have paid none of the principal down, but you also didn't fully pay off the interest. And if you continue to only make the minimum payment, you'll never pay down the principal and the amount will actually increase every month. So that wraps up what I wanted to discuss about credit cards, but I did mention that I was going to touch on credit scores. Now I'll give you an overview, but if you really want to deep dive into credit scores, I recommend the Consumer Financial Protection Bureau's website. The consumer education portion of their website has a lot of useful information, and the section on credit cards is particularly thorough. So what is a credit score? A credit score is a number based on your financial history that indicates your credit worthiness. In other words, how likely are you to pay back any borrowings and pay them back on time? And this score ranges from 300 to 850 and is used by banks to determine how much risk premium to include in your interest rate. Now, this applies to every type of borrowing, including credit cards, car loans, mortgages, student loans, etc. And the lower your score, the higher your risk premium is going to be. And if your score is too low, the bank may not give you a loan at all. Now, a credit score is calculated by consumer reporting agencies, and the big three are Equifax, Experian, and Transunion. And based on your credit report, that's how they're going to calculate the credit score. And your credit report includes the following 5 pieces of information, which again, the consumer reporting agencies use to calculate your credit score. The first thing they're going to look at is your payment history, and this shows if you've paid your bills on time. And obviously any late or missed payments will negatively impact your credit score. Now, one of the most common misconceptions is that you need to keep an outstanding balance on your credit card to build up your credit score, and that's just wrong. It's perfectly fine to pay your balance off in full every month. Now, the important thing is that you use your credit card with some degree of frequency to maintain a payment history. Because what the reporting agencies are looking for is that you're responsible enough to use your card and pay your bills on time. And they need data to support that. So if you have a credit card and don't use it, even though you may not have any late or missed payments, it doesn't really help the reporting agencies to assess how risky you are as a borrower, and it will negatively impact your credit score as such. The next thing they're going to look at is your total debt outstanding and your credit utilization. So for total debt outstanding, there's no hard and fast rule here because everyone's financial situation is unique, and this really has to be looked at on a case-by-case basis. But the idea is to keep your debt manageable. So for example, if you make $100,000 a year and have $300,000 in total debt, and that's mostly from your mortgage, that's probably fine. But if you make $100,000 a year and have $1 million in debt, you're probably over-leveraged. So credit utilization is the ratio of your outstanding balance on your revolving accounts, and typically for individuals this is going to be credit cards, but it could also be a line of credit with a bank, to your total credit limit. And generally, using above 30% of your total available credit will negatively impact your credit score. So for example, if your combined limit for all your credit cards is $10,000 and your balance is more than $3,000, then it may negatively impact your credit score. The other thing they're going to look at is the length of your credit history. And the reporting agencies need a certain amount of data to accurately assess the likeliness of you to pay back any borrowings and pay them back on time. So if you only have 6 months of credit history, they're not going to be able to assess whether you're going to be a good borrower or not, and that's going to hurt your credit score. Now, on the flip side, typically your credit history will go back 7 years. So as a rule of thumb, any delinquencies or late payments will remain in your credit report for 7 years. The next thing they're going to look at is your credit mix. And this is the types of credit that you have outstanding. And this could be credit card, student loan, mortgage, etc. And being in good standing on many types of loans shows the reporting agency that you're able to manage many different types of debts and will improve your credit score. The last thing they're going to look at is to see if you've opened any new accounts or applied for any new credit recently. Typically, applying for or opening several new lines of credit within a short period of time indicates financial difficulty, and therefore that could negatively impact your credit score. Maintaining a good credit score is an extremely important financial decision. Your credit score is going to materially impact not only your ability to get a loan, but also the interest rate you pay. So it's important to build good credit early on, and credit cards are a great way to do this. So what I recommend as an effective way to build your credit history is to get a credit card as soon as you turn 18 and make small charges every month on your card and pay that card off in full each month. Not only is this going to establish good credit history, but it'll also keep you from paying any interest on the charges. So that takes us to the end of Chapter 3, and if you like the videos, please don't forget to subscribe and hit the like button. Also, stay tuned for my next video on Chapter 4, where I'll show you how to quantify the true cost of car ownership. And for more information on the book or additional videos, you can check out the links below or visit my website at michaeltorresfinance.com. Thanks for watching.